Hi class, this is Liz Brown. We are doing some sample problems for Chapter 3 for 2301 Financial Accounting at Richland College. Alright, so here we have an example. This is Crimson Tide Music Academy. We are looking at their unadjusted trial balance as of December 31st, 2018. We are given some information here. We are looking at some of their debits, which include their assets here. Accumulated depreciation is a contra asset. We have liabilities here. Come down here. Some common stock, which falls under our owner's equity. Some revenues here and some expenses. Those are all going to be on the income statement. And some additional information. In this problem, we're going to be doing our adjusted journal entries. So as we can see here, right now, there's nothing in salaries payable, interest payable, utilities payable. We have some interest expense, some rent expense, supplies expense. Those are things we need to book some entries for. Depreciation is that entry that we looked at in the intro video. What we're going to come over here and do is depreciation expense of $6,000 and accumulated depreciation. This is a contra asset. Accumulated depreciation of $6,000 as well. So we have an expense on dealer, that's the E in dealer with a debit, and accumulated depreciation, which is a contra asset. All right, the next piece here is accrued salaries at year end of $2,100. So when we come up here and take a look, we do have salaries expense. That is an E in dealer, so that is going to be increased with the debit. So we have some salary expense, but what's happening is that our year is ending and we have some unpaid salaries for our employees. So our employees do not work for free, and they want to make sure that they've worked and they've earned revenue for us. So we want to do a matching, right? That matching principle, a matching expense, right? And we owe them the money, so that's going to be a liability. So what we're going to do here is we are going to have an expense because they helped us earn revenue, so we need to match that. And we have a payable. We will pay them soon, that $2,100. So we are setting up a liability, and we're going to owe them $2,100 that we will pay in the beginning of the next year. Next up, just coming down here, we've done depreciation, we've done the accrued salaries. We have a loan. So we have principal amount borrowed on September 1st, 2018 was $20,000. For a 4-year loan with an interest rate of 12%. All right, these loans can be tricky. So we have a loan taken out on September 1st. How many months do we need to accrue for? All right, so I like to really think about this because human nature can say, oh, we took out the loan in the 9th month and it's the 12th month. 12 minus 9 is 3 months. That is not correct. So I like to write these out or count them on my fingers. But we need to accrue for September, October, November, and December. That is 4 months that we need to accrue for. All right? So let's do a calculation here to figure out how much we need to accrue. So I like to do it where we figure out what our monthly payment is and then figure out the payment we need for the period that we're accruing. So I'm going to figure out my annual interest. How much interest do I pay during the year? I'm going to take 20,000 times 0.12. So percentages, 12% is the same thing as writing 0.12. I'm going to pay $2,400 each year in interest. Let's figure out what that's going to be per month. So if I have $2,400 per year, if I divide that into 12 months, it's going to be $200 a month. Now, we previously calculated how many months we need to accrue. 1, 2, 3, 4. I need to take $200 for 4 months, or $200 times 4 is $800. So what my entry is going to be here is I'm going to have interest expense of $800. We are not going to pay cash. We are going to accrue this in a payable account, and when we pay the full amount in cash back to the bank, we will pay them for both the loan principal and the interest. So we're going to put this into a liability account. So I've gone ahead and created this where it's going to pull those numbers in. So that's our journal entry here. Interest expense increased by $800, and we increased what we owe the bank of $800 as well. Next piece, we have unused supplies at year end of $700. I want you guys to all pay attention here. This is the most missed section of the project for the account. So please watch what we're doing here. Please take a look at your book or reference this video as you're doing the project. So when we come up here and look, as of December 31st, 2018, we have a supplies balance of $2,000. What we do is then we go after the end of the year and count how many supplies are in the room. We go in and we count and we see, oh, we have $700 worth of supplies in the room. All right, so that might be a confusing concept, but when you have supplies, these are things you're grabbing one at a time. So say you have pencils and pens. Each time you go into the supply closet and grab 4 or 5 pencils or pens, you're not going to create a journal entry for that. That would be a lot of work. So usually when this happens, we're going to do our journal entry at the end of the period. So we had $2,000 in our supply closet. Now we've done a count and we have $700. Okay, so here's what we've got as of 12/31. We know that we had $2,000 in our supplies. We've done a count and we know the ending balance should be $700. So what do I need to do for a journal entry to take this from supplies of $2,000 down to supplies of $700? That is going to be an adjusting entry of $1,300. All right, so $2,000 minus $1,300 is $700. So let's come in here. The entry that we're going to use here is we're going to have a supplies expense. So we've used up this much. We've decreased our asset. In using those, we've had a supply expense, so we need to increase our expense with a debit, and we need to decrease our actual asset with a credit. All right, so that is a confusing entry. So the things to take away is that we're going to have a balance. We're going to do some kind of count and determine what we have at the end of the period, and we're going to need an adjustment right here. So we're going to need to credit the supplies asset. So credit the supplies asset, make that go down, and increase our expense. All right, the next entry that we're going to do is our prepaid rent. So on 4/1/2018, so in April, we prepaid a year's rent for $7,200. The problem goes on to tell us we have $600 as our monthly rent. When we look at, let's go up here to prepaid, we have prepaid rent of $7,200 as of December 31st. That's not really the case. At the end of the year, we don't have $7,200 in prepaid rent. We have used up, as a cost of our business, portions of that rent. So what we consider that piece is our rent expense. That was our cost of doing business. So we know the rent is $600 per month. How many months should we put in our journal entry? Well, we have April, May, June, July, August, September, October, November, December. You can count this out on your fingers. You can write this down like I have. I'm going to highlight all of these. I'm going to look at my count, which is 9 here. So I have 9 months that I need to accrue. Now, we say that rent is $600 per month. So 9 times 600 is going to be $5,400. $5,400. So what we're seeing here is I used to have an asset of $7,200, which was the asset of having rent that's already prepaid. I have used up $5,400 of this rent. Now I only have $1,800 left in my asset. In using this up, it was my cost of doing my business, my rent expense. Oh, let me scoot this down, excuse me. It was my cost of doing business, $5,400. And I'm also decreasing my prepaid rent. So coming up here, my asset is decreasing, my expense is increasing. So here is our entry. Rent expense, $5,400, prepaid rent, $5,400 as well. Last entry here, unpaid utilities for December. I had a cost of doing business. I had my lights on. My customers are not going to walk into my store if I don't have the lights on. So this is definitely a cost of business, but I haven't been billed yet from the utilities company. So I know that I've had an expense and that I owe for that expense. So I have a liability. So $200, I'm going to come over here. Oops, that didn't update. I'm going to come over here and I'm going to add $200 in my utilities expense and $200 in my payables. I hope this was a helpful example.